So, we continue now. This is lecture 8. Lecture 8. We are on chapter 3. Section is in my textbook 2. And we are on conventional measures. The next measure is 4. Yield to put. And 4 yield to put is on page 42. And yield to put works exactly the way it works for yield to call. You got a put schedule. And the put schedule will give you a put date. And a put date is simply the date on which the bondholder can put the bond to the issuer. So, put date, and the schedule for each put date, it will give you the put price. And you calculate now yield to first put. Yield to first put simply means if the put date has not yet come, whenever the first put date comes, you know the date, you know the price, and you can calculate the yield for that date and that price of the first put. Then you have yield to next put. If the first put already come, next put coming in a year, you can calculate how much it is until the next put. So you got the same concept. Yield to put is calculated. What's going on? All right. Yield to put is calculated in exactly the same way as yield to call. Uses the same formulas, the same procedures, the same steps, the same everything. It is identical. The next measure is yield to worst. And yield to worst simply tells you what is the worst possible case that can happen to you as an investor. It basically tells you, or basically calculates the yield for every call date, the yield for every put date, the yield to maturity. You calculate all possible yields and you take the lowest of all possible yields. And the lowest of all possible yields becomes yield to worst. So, as an investor, you're saying, oh, if I buy this bond, yield to call 215 is 6%, 216, 7%, 218, 6.5%. Well, yield to put is 8%. Yield to put then is 8.5%. And then you may have yield to maturity, 9%. I say, well, the worst I can make is 6%. The lowest of all possible yields. Okay, that's the worst that you can do. Next one is called cash flow yield. And cash flow yield applies to amortizing securities. Amortizing securities. An amortizing security is security which pays not only coupon, but also pays partially the principal. One particular example is mortgage loan. A mortgage loan will be paying interest and principal. It will be paying principal down slowly and steadily until on maturity there is little principal left. Another example will be car loan. In a car loan, it's the same situation. You're paying every month $300, $200 will be going towards interest, $100 will be going towards principal, and you're going to be paying steadily down the principal. To amortize means to pay down the principal, paying down the principal. In a regular bond, when you pay coupon, you don't pay the principal down. The principal is due on maturity. You don't pay anything from the principal. With amortizing securities, you pay the principal down with every single payment. And that's the big difference. So, when you have an amortizing securities, you have a major risk, and the risk is that of prepayment. And prepayment is paying more principal than it has been originally scheduled. So, in amortizing securities, you have a schedule of payments. You got a schedule for a payment date and a payment amount. And the payment amount includes interest, it includes principal. And prepayment means that they're paying more than the scheduled amount, and therefore they're prepaying part of the principal. So that's the prepayment, and therefore these suffer especially from prepayment risk. Let's give you a good example. Good example is when I was a PhD student in the United States, and I did my PhD in 1998. I defended my second major exam, and it was clear that I'm going to become a PhD eventually in 99. So in 1998, I said, okay, I can buy me a car. Actually, I would lease a car, a Ford Mustang, for $15,000. And they gave me a 5-year lease. And on a 5-year lease, my payment was $283. I said, okay, I can pay $280 every month until I graduate. But here's what happened. When I was a PhD student, I was making only $1,000 a month, $1,200 a month. And with $1,200 a month, I was easily making the $280 payment. When I graduated and got a corporate job in 2000, I was making 5 times more. I was earning $6,000 a month. And now I said, hey, I don't need to pay all of that interest or anything else. In 2000, as I got my corporate job, and I had, effectively, it's a car loan. Technically, it was a car loan from the leasing company. The leasing company technically owned the car, but I asked them 6 months later, say, hey guys, if I want to pay off my car, how much do I need to pay you? And they said, oh, next month you're going to need to pay $8,000, something like that. And I said, oh, I saved about $5,000, okay. I'm making $6,000 a month. I can save after tax and everything for. So I said, okay, if I send you these $8,000 at the end of next month, they said at the end of next month, send us $8,000, I don't know, $300. I said, okay, I'll send you at the end of next month $8,300. So I did actually prepay the whole thing up front. So out of a full loan of $15,000, I've been paying down for 2.5 years, and instead of holding on to 5 years, at the end of 2.5 years, I just took all the money, write them one big fat check of $8,300 or whatever, and prepaid the whole thing, paid it off completely. Well, guess what happened then? That was 2000, well, end of 2000, that's where I got my job, 2000. Interest rate just fell big time. Well, suddenly, in 1998, they were paying, well, I was paying them 7-8% interest. They could not reinvest or get anything like 7 or 8% in 2001, end of 2000. They could barely get 3 or 4%. So I prepaid, I wasn't paying the big interest rate anymore, and at the same time, they were getting from me 8% interest. Now they could reinvest at most getting 4. This means that they suffered a loss, we call it opportunity loss, of 4%. They could have been getting 8, but they were effectively getting their money, they reinvested, and they were getting only 4. So 4% they weren't getting. We call this opportunity cost or opportunity loss. Money they could have been making, but they're not. Well, that's the prepayment risk. This is the tricky and the difficult part. And from here, you got this cash flow yield. This is page 43. And this is basically the yield or the interest rate which will make the projected cash flows of the security equal to the present value. In other words, you will have to make a projection of the cash flows. You will have to project the prepayment, and based on that, you will be calculating the cash flow yield. And now here's the question that you're going to be asking, well, how could they ever possibly know if I'm going to prepay 2 years early, or 3 years early, or 1 year early, or I might not prepay? And the answer is diversification. They will have 1,000 mortgage loans, 1,000 mortgage loans pooled together in what we call asset-backed security. And when they have 1,000 mortgage loans, they will know that 1%, 10 out of 1,000, will prepay 4 years in advance. Then they'll know that 5% will prepay 2 years in advance. They'll know that 20% will prepay 3 years in advance, okay? Maybe another 5 or 10% will prepay, so let's say 1 year in advance. And they will know that maybe 50% of all loans will have no prepayment. So the answer is, because you have a lot of loans, you can statistically evaluate and estimate, based on previous observations, what is going to be the average life of a loan and what are the expected prepayments. You build in the prepayments, the expected prepayments, because you know, first year so much prepayment, second year so much prepayment, third, and based on that you can estimate the future cash flow. You know the current price, and that's how you get the cash flow yield. I think cash flow is with a, no dash. All right. Next, 7. Portfolio yield. Portfolio yield. Portfolio yield is actually the yield on a portfolio bond. You may have 2 bonds, 3 bonds, 5 bonds. You may have 100 bonds or 1,000 bonds. You have a portfolio which includes 2 or more bonds. Well, here is the most common mistake that you should remember. The yield is not the average of yields of bonds. So if you got two bonds, one yielding 5 and one yielding 10, the average is not the portfolio yield. So yield on portfolio is not the average of yields. And it is not the weighted average of yields. No, not. Okay? Because of different maturities, you cannot average out yields. There is no way around except through full calculation. You have for each bond, you have the expected cash flow. Then you sum up all cash flows, and that's how it works. So you got bond A, bond B. Bond A pays 5%, so it's going to be 50,050. Bond B is paying 40, 40, 40, and then you have 1,040. Then you have to do A plus B, and you total the cash flow. The total cash flow is 90, 1,090, 40, 1,040, and you calculate yield like any other yield. This particular yield is, as I explained already, guys, you will sort out your thing later, okay? If you have a question for me, ask me. Have a question? Is there a question you have? Question? This is simply internal rate of return. Remember, yield to maturity is an internal rate of return. So, you have two bonds, you total the cash flow for the first year to get the first year cash flow, the total the cash flow for the second year, and you get the total cash flows for the third year, for the fourth year. Now you have the total cash flow, and based on the total cash flow for each year, you calculate the portfolio yield. But it is not a simple average. If you got two bonds, 5 and 6, doesn't mean that the average is going to be 5.5 or some average between them. Not necessarily true. Mathematics doesn't work. Okay, that's the portfolio yield. Let's do this. Take a look, and we'll do this with the camera. Take a look on page 44. Now, let's see if this Sony camera, can you zoom in real big on this nice table? Can you zoom in real big and see if the Sony works really good? We'll check later on. And you're looking all on page 44. You see, period cash flow, bond A. Everybody, take a look at bond A. And bond A has got, what is it? 350, 350, 350, 350. At the very end, it's got 10 million and 350. Bond B, it's got million and 50,000, million and 50,000. And at the end of period 14, it pays you 21 million and 50,000. And then have bond C. Okay? That's everything on page 44. Everything on page 44, the little table. And then you see portfolio. And you see the portfolio, the first number is 2,300,000 second year, 2,300,000 third year, 2,300,000, and all the way to 21. And then you take this portfolio and compute only for that portfolio, meaning the total of the cash flows, you compute the yield, just like any other yield. You can use a calculator, financial calculator, to punch in the numbers over here. You can also use Excel, you can use computers, you can use software, and that's how you calculate. And that's page 44. And that's portfolio yield. Now we're moving on to yield spread measures. So I'm going to delete this case here. And write measure number 8, page 44. Yield spreads. And you have a whole bunch of spreads. The first one is the quoted margin. And the quoted margin refers to floating rate securities. Securities with adjustable rate. They have a benchmark and the quoted margin. So one type of a spread is the quoted margin. So quoted margin stays fixed. It is quoted at 3%, 4%, or 2%, and whatever is the benchmark, it will be above. It's going to be floating with the benchmark, maybe 2% above the benchmark. So that's one example. Now, there's a whole bunch of others, like spread for a life. Probably I'll continue over here. This continues 8, spread for life. Also known as, let me write it here, simple margin. Another type of measure is adjusted simple margin. Now, again, there's also adjusted total margin, and the most popular one is called discounted margin. Or, oh, sorry, my mistake. Discount without discount margin. Discount margin. All right, so what's the discount margin? You assume that the reference rate or the benchmark will remain constant. You already know that the quoted margin will be also constant. And based on the current price, constant reference margin and quoted margin is always constant, never changes. You calculate the yield like any other yield to maturity. So you calculate it like any other yield to maturity, and if the price is selling at a discount, this simply means that the discount margin will be higher than the quoted margin. And if it's selling at a premium, this means the discount margin will be lower than the quoted margin. And if it's selling at par, this simply means the discount margin will equal to the quoted margin. So basically, the discount margin adjusts the quoted margin for the current price of the bond, which might be selling at a discount or selling at a premium. And that's just a calculation. You have very detailed and extensive calculation on page 45. So it shows you step 1, step 2, step 3, step 4. You'll have to look at it and see how it works on your own. 45. All right, we have section 3. And section 3 is sources of bond returns. So, return sources. And it's very simple. If you buy a bond, where do you get money from? And you get money, number one, from periodic coupon. So, if you invest in bond, you always get income, meaning like cash flow from your coupon, periodic coupon. That's number one. Number two is, or B, capital gain. Capital gain or capital loss. If the price went up, you get a capital gain. If the price went down, you got a capital loss. Here's the next piece. If you actually sold the bond and you actually realized it, it's called realized capital gain. Realized means you actually sold the bond and you actually got a gain or you actually got a loss. But it might be unrealized. Unrealized gain is also known and is also called in finance, and you're going to hear this a lot, paper gains. Paper gain. Paper gain is not really a real gain. Yes, the price went up, but profit, meaning gain, is realized only when it's sold. So unrealized is more a gain on the books. It's not really a real gain until you actually sell it and until you actually cash in the gain itself. So capital gains. Actually, we're looking only at realized gains. And C is called reinvestment income. Okay, well, reinvestment income means when you realize a capital gain, you invest that gain again. It always happens also with the coupon. You have a coupon, when you cash in the coupon, you reinvest it again. Well, that reinvestment income, and let me delete this stuff over here to clear up some space for you. And introduce some terminology. The periodic coupon, A, in finance is known as current income. Current income is income which you get from investment during the current period. So for 2007, whatever the coupon is classified as current income. That's the reason why I have it as A. So current income is exactly the same as periodic coupon. Actually, the periodic coupon is the only form of current income. It is the form of current income. Current income applies for any investment. Current income applies for real estate, and the current income of real estate is called rent. It applies for stocks, and the current income of stock is called dividend. It applies for bonds, and it's called coupon. It applies for currencies, and it's called interest. It applies for commodities. If you have gold, it's the rental rate of gold. We call it lease rate. Okay, so every asset has a current income, and the current income of bonds is the periodic coupon. Now, this one is called reinvestment income, is also known as C, interest on interest. Interest on interest. Well, here's what's important to understand. For long-term maturities, like 10 years, 20 years, 30 years, the reinvestment income, the interest on interest, will give you the bulk of the income, the bulk of the cash flow. It could be easily 50, 60, 70, 80, or even 90% of all the cash flow will be interest on income. If the security is paying very high, interest, it is entirely possible that the interest on interest is a very big chunk of the, we call it now, total return. Total return. So, total return of a security, of a bond, is the return of the current income, the capital gains and losses, and the reinvestment income. So, for many long-term bonds, the dominant income is the reinvestment income. But what is the reinvestment income depend? Reinvestment income depends on the reinvestment rate. This is the interest rate at which you will reinvest it. And reinvestment income is subject to the reinvestment risk. So, for many long-term bonds, the biggest risk is actually reinvestment risk. So, C gives you reinvestment risk. Turns out that for long-term bonds, reinvestment risk affects the largest part of the cash flow, 70–80%, and therefore is the largest type of risk. And let's see what else we have, okay? Now, let's see what else we have. We have 10 more minutes. Part of this is known as, and let's explain now, promised risk. Sorry, promised yield. So, promised yield is the yield of return if there is no reinvestment risk. So the promised yield assumes that the reinvestment rate will be exactly the same as the original yield to maturity. So promised yield is the same as yield to maturity. So yield to maturity assumes that the reinvestment rate will be exactly the same as the yield to maturity. So if the bond yields 5%, yield to maturity assumes that 1 year from now, when you get the coupon, you're going to reinvest it at 5%. 2 years from now, when you get the coupon, you're going to reinvest it at 5%. 3 years from now, you're going to reinvest it at 5%. So yield to maturity main weakness is that it assumes that the coupon, meaning the current income, will be reinvested at the same yield as the yield itself. So if it's 6, It's 6. It's 6. It's 6. So the fundamental weakness of yield to maturity is that it ignores completely reinvestment risk. So it is what is called promised risk. This is what they promise to pay you if you can get the same type of yield. Well, now we come to the next simple question. Well, where is the reinvestment risk lowest? And the reinvestment risk is lowest where you have low coupons. So let's write it out. 0 coupon bond has no current income, has no income during the life. And therefore, there is nothing to reinvest. So, 0 coupon bond has, we say, no reinvestment risk. Absolutely no reinvestment, because there is no coupon in the first year, there is no coupon in the second, there is no coupon in the third year. There are no coupons to reinvest. There is nothing to reinvest, and if there's nothing to reinvest, you know for sure now that there is no reinvestment risk. Only for a 0 coupon bond, the promised yield is the same as the yield to maturity, is the actual or realized yield, the total yield, subject to no reinvestment risk. But here's the key. If you hold it until maturity. Let's see what else we have. So we are finishing for today. Determining interest on interest. Okay, 47. Yield to maturity and reinvestment risk. Okay. Okay, so here is one other basic piece. It's, again, amazingly simple. If the maturity of the bond rises, meaning instead of 5-year bond, you take a 10-year bond. So as maturity increases for bonds, reinvestment risk increases. Reinvestment risk increases. So, reinvestment risk increases for that particular bond. In the sense, you get one coupon, now you got to reinvest it for 9 more years. Well, if it's a 20-year bond, you get your first coupon, you got to reinvest it for 20 years, okay? So, the longer is the maturity of a bond, when you get a coupon for a longer period, you have to reinvest it. And the reinvestment risk is higher. Now, it's important to understand, because we had in the previous hour, that reinvestment risk does not mean you suffer a loss. It means you suffer a loss if the risk, if the rate at which reinvest is lower than your yield to maturity. What can happen is, right now you're yielding 5%. Next year, you're yielding 6. And you say, great, I'm making now 5. Next year, I'm making 6. Actually, the reinvestment risk turns into a profit for you, a gain. You are increasing your yield. So, reinvestment risk is only if the reinvestment rate is lower than your current or promised yield, okay? But it may be higher, and if it's higher, great, you got lucky. You are making an unexpected gain, okay? So, that's important to understand. All right, let's see what else we have until we're finishing with section, okay? The longer the maturity, the greater the investment risk. Oh, okay, coupon. The next one is, again, very simple, very easy. If the coupon is higher, it will for sure mean that your reinvestment risk is higher. Right? If the coupon is small, you get a small amount. When you reinvest, the risk is small. If the coupon is twice bigger, your reinvestment risk is basically twice bigger. So the higher the coupon payment, the higher the reinvestment risk. And finally, you have a discount bond, okay? And it sells at a discount. If it sells at a discount, the bigger the discount, then the total yield is coming from a discount. So the lower the discount, if the discount is small, then you have a lot of reinvestment risk. If the discount is large, then you have less reinvestment risk. Okay? So, let me try to again explain this piece so it can go home. If the discount, suppose you got $1,000 bond, face value of 1,000, sold at 500. If it's sold at 500, most of your income will come for capital gain from 5 to 6 to 7 to 8 to 1,000. So you get yourself a guaranteed from 500 to 1,000. You get yourself a return which you don't need to reinvest. Okay? So if you have a huge discount, you get a guaranteed return, but you don't reinvest it, because the discount bond does not bring cash flow in the meantime. So if the discount is huge, the reinvestment risk is small. The opposite, if the discount is small, the reinvestment risk is high. Now, the discount could turn out to be a premium. So if you have a higher premium, it means that you have a higher reinvestment risk. Sorry. Discount smaller. Sorry, mistake. Discount smaller. Reinvestment risk is higher. So as the bond price goes up, the reinvestment risk increases. And if it's a premium, the reinvestment risk is even higher. Yeah, that's it. So if the bond is dirt cheap, reinvestment risk is low. If the bond is expensive, the reinvestment risk is high. All right? Everyone's staring. All right, well, that's good for enough. You got to read it, and if necessary, I'll repeat it next time. Okay? Okay, and that's up to page